Hey everybody, good to be here. My name is Brent Morse. Time to wrap up the week. Ooh, it's been quite a week, everybody, and glad to finish it off with you. This is just a reminder, this is a half-hour session today. I'm here with Cameron May, who's helping me on the chat today, so I appreciate Cam. If you have questions, feel free to type those in. Between Cam and myself, we'll do our best to help you out. You can follow either of us on X, at Brent Morse CS, at Cameron May CS. The information today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart type. And options do carry a high level of risk. I don't think we'll be doing any options today, but just be aware of that. The Paper Money software application is provided for educational purposes only. We will be looking at the Paper Money, the Thinkorswim desktop platform. Schwab does not recommend the use of technical analysis as a sole means of investment research. And all investing involves risk, including risk of loss. No guarantee of execution of a stop loss at or near the stop price. What are we going to do? We're going to talk about the general trends in the market, what moved the market this week. We'll look at different time frames, support and resistance levels, and so on. Yeah, what a week is someone said that in the chat. TM said, what a week. I would agree. It is. Here we are. This is how we finish off. You can see some big candles there. Although it's actually gone down a little bit in terms of the height of the candle, the range of the candle. It's actually been a little while since we've seen it. You can see that reflected in a couple ways. One thing you can see, and I'm going to go back to that SPX chart in just a minute, but let me just show you this real quick in terms of the volumes out there. Here's today's volume. You can see this is volume on the S&P 500. You can see it's a little less today. Maybe a little bit more calmer minds prevailing today, I'm not sure, but you can see that just the absolute jump in that S&P 500. You know, sometimes people ask, why don't they show the volume on the S&P 500? Technically, there's not a volume on the SPX index itself because the SPX index doesn't trade. You can trade options on it. Can't trade the index itself, but this is basically taking the total volume of the component parts of that S&P 500. So there we go. There's that. You know, you can also see what state has the market been in while I'm here, while I have this up. Here's the percentage of companies. So this is a graph of the percentage of companies that are above their 50-day moving average in the S&P 500. What are we at? About 20%, about 1/5 or above. Now, that's not like a huge ask above their 50-day moving average, but that just kind of shows where the market, where the index goes. Generally, that tells you about a lot about the, you know, the parts of it. Now, sometimes it's not totally equal because the SPX is market cap weighted. Well, let's see. Look, I mean, that's a decent candle. Let me just zoom in. That is a bullish engulfing candle. You know, the body of this candle is bigger and green as compared to the last one. So that's a strong way to finish the week. If we go intraday, here's how we finished. A lot of times what we see is, you know, it rallies, and then it kind of fades into the close. We didn't really see that today. Here's today's trading. It held tight there. So that actually is, you know, there's no perfect, I cannot prophesy what is going to happen next week necessarily because there's always new news that's going to come out and move the markets. But in terms of the technical analysis, today was a strong day. That's all I can say on that. That's a strong day. That bullish engulfing, the strong close on that graph. Where's it going to go in terms of support resistance? Obviously, the low price of, when was that low price? That was Monday. Was that Monday where we hit that low and bounced off? That's a significant level. If we break below that, that would be not a good thing, obviously. Resistance, well, that kind of our previous lows before everything fell apart, I guess, is where I'd consider some potential resistance. Old support becomes new resistance. That coincides, by the way, with that 20-day moving average. On these graphs I show you, basically I'm going to have a 20-day and a 50-day moving average for the most part. That's the 20-day moving average. And there's the trend line. So there's kind of your line in the sand in terms of if we break above that, that would be a good sign in the market. So that's the SPX. I think if you do SPX EW, the equal weight, it doesn't look that dissimilar, does it? Today's candle's not quite what it was on the SPX though. See that bullish engulfing that we saw on the SPX? On this SPX EW, it's bullish. It's bullish. It's not as bullish. And what that tells me is some of the extra bullishness was driven on the top end in terms of the market cap end of the equation. In other words, some of the bigger market cap stocks helped the SPX outperform the SPX equal weight there. And there we go. I think that's enough on SPX. There is a survey link in the chat, by the way. And oops, SPX. Let me just zoom out. We looked into the intraday chart. Here's today's chart. Let me go to the yearly chart. Here's the yearly chart on the SPX. Now, obviously a substantial drop. One thing, not a year, yeah, this is a 3-year chart, I should say, weekly. Each of these candles are weeks. You can see the rundown we've had. We've had a nice green candle here this week. That's good. I thought I'd show you this. I thought this was kind of interesting. This is the Fibs. This is a Fibonacci. If you go from low to high on that 3-year move. So that's a big move. I mean, that was over 2 years it took on that bull run that we had. But you can see where that 50% level is. It's right there. That's right where we're at. So, so far the 50% is held. I don't know if it's going to continue to hold, but there it is, zoomed in. There's that 50% level. Let's look at the NASDAQ real quick. Here is the NASDAQ. Again, nice little bounce. Again, bullish engulfing. NASDAQ, for the most part, looks pretty similar to the S&P 500. The Russell is a little bit different. I mean, the NASDAQ's up 1.9% today. The SPX, 1.8%. The Russell 2000, 1.6% there. A little bit less. It is certainly possible that interest rates are dragging on the Russell 2000. The higher the interest rates, that does not do well. Small cap stocks, which is the Russell 2000, tend to be more heavily affected with higher interest rates. We'll look at interest rates in a sec, but interest rates have not been favorable to small caps of late. In fact, let's do that. I'm going to go to the VIX in just a minute, but let's just look at that TNX here. TNX colon CGI. This is the 10-year. See that jumping up? Well, why are rates going up? Well, rates are going up because bonds, the treasuries, are going down. Why are treasuries going down? Because people aren't buying treasuries right now. And that can be kind of counterintuitive to people, to be very honest, of, when the market's kind of jittery, which it's been for the last little while, no doubt. I mean, today's been a little bit better, but markets have been jittery. And so sometimes people will escape to bonds in that case. But in this case, not so much. People are selling U.S. treasuries. U.S. treasuries have gone out of favor, it seems, over the past week or so. And, I think certainly it's hard to say it's not related to the potential kind of trade war with China there. We'll see how that goes, but we're at 4.5% basically. But that is affecting other parts of the market too, and it's affecting mortgage rates. Mortgage rates, I saw an article just a little while ago, mortgage rates, average 30-year mortgage rate, 7% right now. Okay, so that's jumped up. That has jumped up a little bit here. Let's take a look at the VIX. So here's implied volatility. By the way, implied volatility, for those of you who aren't aware, a lot of you are aware, this is a measure of implied volatilities on S&P 500 options. Of S&P near-term S&P 500 options at the money. 37% 37, okay, 37 implies that there's a 37% implied move, annualized move in the S&P 500. Okay, that's a pretty big move. You take the S&P 500 right now, up or down, because it's not directional. It's not saying up definitely or down necessarily, up or down, 37% move up or down. That's high. Obviously, you can see that in the chart. It's high. Normally, we don't hit those levels. And by the way, those of you who are interested, I did an X post yesterday, talking about translating that into a daily move. So check out X at Cameron May CS, at Brent Moore CS. But basically, to kind of make that into a daily move, we use something called the rule of 16. And basically what you do is you take the VIX and you divide it by 16. So if it were 32, to make the math easy, 32 divided by 16, that implies about a 2% daily move on the markets, implied from that. Doesn't mean that's exactly what you're going to see. In fact, lately it's been above that, the daily moves, but the assumption is, I think for a lot of people, is that VIX is going to, will decline at some point. So interest rates up, would that drive? Interest rates up can certainly be a drag on sections of the economy. So TM said, interest rates up, does that drag the economy down? It's a multivariable thing, the economy. It's very complex. However, there are parts of the economy where high interest rates can certainly hurt things, no doubt, because it makes the cost of borrowing higher. You want to buy a house, the cost of the house is higher. You're a company, you want to invest in things, you need to take debt financing, that cost is higher. It tends to slow down the economy. That is why the Fed, when they're worried about inflation going out of control and they want to slow down the economy, they want to cool things down, what do? They will raise interest rates. Okay, that's their method of one method of trying to cool things down in the economy. But there is many factors in there. But of course, what the market, when the market goes down, when there's struggling parts of the market, there's areas where money goes to. It seems like they're not going into bonds right now. We've seen that. It seems like they're not going into stocks other than today, right? Where's it going? Well, one place is gold. Here's gold, up 2.5% almost today. That's an all-time high, by the way, on gold. This is the gold future. We're not talking about trading futures today. This is just telling us, we're just using this to show us what the price of gold is. Of course, some people will trade ETFs and whatnot. I'm not going to get into ETFs today, but if you're interested, that's, these are one of many things that you could do. But the price of gold is high, all-time high right now on gold. That's one place that money is going. By the way, did I say, I can't remember if I told you there was a survey link in the chat. There was a survey link in the chat. You may need to scroll up just a little bit on that. But if I forgot I can't remember what I mentioned and what I didn't mention. That's one place that money is going. One place that is sometimes used as a kind of an economic measure is oil. This is the West Texas crude oil. This is kind of the standard measure that is used in the U.S. $61 a barrel. That is you can see where it's gone down. This is probably not a strong sign for global demand. Now, this has gone down, and you may be going, well, what about the gas at the pump? Let's do this. Let's go and I'm going to stay on CL for a sec. And I'm going to change this chart to a year-to-date percentage chart. What has crude oil, done over the past, well, this year so far to date? Down about 16%. What has the refined product, RB, we call that RBOB, what has that done? Down 16%? No, down 2%. Huge difference. So you're going like, oil price has gone way down, but the price I'm paying at the pump hasn't gone down that much. Well, let me switch this up for a sec. I have a grid here. This is the let me just, I want to move this there. Okay. This is the spread between oil and the refined product, gasoline. Okay. And you'll notice during that same time period, we said year to date, oil was way down. Year to date is from here. Here's beginning of the year. To now, oil has gone way down, but gasoline hasn't gone down that much. That's because the difference in price has gone up between what's extracted, the crude, and what is at the pump. So we're paying more essentially for the refining process right now. And so that's one thing. Of course, oil is not energy. You can look at the energy. Here's the energy sector. You can go to oil, and it doesn't look that of late. They've both kind of gone down significantly, but there's other areas that haven't gone down. This is Brent crude, by the way. This is kind of more commonly used in Europe as the standard crude. And here's heating oil. Graph looks pretty similar on heating oil. Here's natural gas looks totally different. And so sometimes we see a difference between energy and oil, and there's different components to energy, including things like natural gas, which is actually held up pretty well. Okay, let's go on and take a look at what is going on in the markets in terms of things moving the markets. One thing is we kicked off earnings season today. The S&P 500 earnings, actually, let me go back to my normal view here. We had JP Morgan come out with earnings this morning. By the way, if you want, if you want to read about it, you can always click on live news, and then you can look at the some of the headlines. And then if you want more detail, you can just click on those. Okay, click on that. It actually opened up in a different window. I had to move it over there. But if you want more detail, you can do that. But you can see about the company, and sometimes even not even reading the article, you can see Jamie Dimon says recession risk now over 50%, and so on. JP Morgan warns economy, and so on here. So there you go. You can, if you want to know, they beat their revenue expectations. You can read more on the article there. But you can see, bottom line, it's up 4%. That was earning. That's one of the first ones for earnings season. Another one, it's these financial companies, right? Here's Wells Fargo, not up 4%. This one's actually down 1%. Obviously, their response has not been as good in terms of the trend support. You see all these lows here of late. From a technical standpoint, even though the trend is down, we've tested the lows. In fact, we went a little bit below here a few days ago, but it's recovered. It'll be interesting to see if that can hold up there on that. That was Wells Fargo. I didn't even look at the chart that much on JP Morgan. JP Morgan, nice, strong bounce up from the lows here. Probably like to see, I would say, from a support resistance level, something kind of in here where we had the bounce gap, bounce, and if we could break above there, that'd be a nice little break for that. The other S&P 500 stock that I know of is, which isn't a financial company, had earnings today, is Fastenal. Wow, that's a big candle, man. What are they at? Up 6% today? A lot of volatility on that. Now, if you want to look, I said earnings season is kicking off. You can go to MarketWatch. Let's check out the calendar. Here's S&P 500. I'm going to change that to S&P 100 just to get just look at the kind of the essentials here. Here's today, S&P 100, JP Morgan, Wells Fargo. Coming out next week, Monday, Goldman Sachs. Tuesday, Bank of America, Citigroup, Johnson Johnson, Abbott. And so you can see a lot of these are financial companies. That's typical. And you can scroll down the list and see your other companies that are coming out. Got a lot of the next 3 weeks are going to be huge earnings weeks. Normally, I would say earnings is more likely to dictate where the market is going right now. And I'm not going to say it's not an important thing. What we want to see is corporate earnings good, of course. However, a lot of earnings, and a lot of you have experienced this, when a company comes out with earnings, it's not just what the company's earnings were, it's projections for the future. The problem is, in the current environment, projections for the future are more uncertain than I can almost ever think of. Maybe COVID was, there was a lot of uncertainty there. And before that, the financial crisis. But right now, there's a lot of uncertainty. So companies are having a hard time projecting for the future. And the same thing can be true, by the way, for employment, or not employment, economic reports, including employment. So, for example, this week we had CPI that came out. The numbers on CPI, they were better than expected. Annualized 2.4% versus 2.5% expectation. That's good. Okay. Today, PPI came out. This is the not annualized, this is month to month, minus 0.4% versus a plus 2%, plus 2.2% expectation. Spectacular. Inflation numbers could hardly have been better in terms of looking for lower inflation this week. But that's not why the market was moving. I mean, yesterday we had good inflation, the market went down. Today the market went up, but I don't get the sense that it was from the inflation numbers so much. And so, because right now we're a headline-driven market. And so whatever is coming out, which I just talked about, the inflation numbers, we had unemployment came right in as expected on Thursday. Consumer confidence was down today. That didn't seem to spook the market too much. Next week, we have retail sales on Wednesday. Jerome Powell speaks on Wednesday. Retail sales is a big number typically. Employment numbers on Thursday. So all that stuff I hate to say it, it may be actually pretty insignificant compared to any headlines that come out regarding tariffs or trade or economic, policy statement stuff. Kind of strange. I mean, how long were we going where we were waiting with bated breath over every inflation number that came out? Okay, let's take a quick look at the heat map here as we're starting to get low on time. Let's go to the Visualize tab. And this is the S&P. Let me go S&P 500. Here's the S&P 500. I think a lot of you are aware how this looks. The bigger the box, the bigger the rectangle, the bigger the company. Green is up. And you can see, look, a lot of green today. A lot of green, few little standouts there. You can always click on those, by the way. Texas Instruments, miserable day. And you can look at that, and if you want go to Texas Instruments and read the news. We already talked about the news on those if you want. Okay, but one thing to do is consider on the heat map, it's broken down by sector. Today, it's not that, I mean, it's green pretty much across the board today, where all the sectors look pretty strong. But there's plenty of days where you get mostly green, but you'll see a couple sectors out there that are hanging around in the red, okay? And vice versa. Some days you see a lot of red. In fact, we saw it this week. We saw a lot of red, but one day consumer staples actually looked pretty good, and I think it was like utilities looked pretty good, and healthcare looked so-so. And so what that tells me is that's kind of more of a defensive rotation in the market. So there you go. Now, in the chat, Gary said, software is not so hot. We can break this down by, let me just shrink this down. You can break this down by not just sector, but you can go by industry groups as well. Am I off the page here? Why is this not showing the whole? Oh, I guess, never mind. Oh, well. Okay, so anyway, you can break it down further. Of course, you can click down here if you want and go into a particular area. So information technology, you can open that up and click on software or something. Another thing you could do is if you take your finger, you've got a finger, hold the shift key down and click on IT, for example, look what happens. It gives you the heat map for the sector. Okay, so this is not an S&P 500 sector anymore. This is a IT, excuse me, this is an S&P 500 S&P 500 heat map. This is now a sector heat map of IT. If I want to break it down further, and you can see it's a little bit more mixed here in the software. And this, remember, this is just for today. But if I want to look at this further, I can hold down my shift key, click on that, and then it breaks it down further. You know, system software, application software. And so you can see a much more granular view, I guess, of the heat map, and you can use that to your advantage here. So I'm about out of time here, folks, but let me just look at a couple companies that were bigger movers today. Actually, you could probably see that on the heat map, if I can click on the right thing. And let me go back to S&P 500. Apple, up 4% today. So the thing with Apple, we'll have to see going forward on Apple, is Apple has struggled. One reason, Apple's been just really poor. They bounced back a little bit, but they got hit pretty hard with tariff news. Obviously, Apple outsources a ton of their manufacturing to China. Well, with the tariff discussion, that's a big deal. How much is an iPhone going to cost? That's the big question. So there's been speculation in the news today that maybe there'll be some like exemption for Apple. I don't know exactly why they would get the exemption. I don't know, just because they're such a big player, big iconic US company. And I think that may be spurring some of the nice jump we had on Apple there. So that would be big for them, because potentially if the tariffs stay high and there is no exemption, Apple is likely to be suffering big time financially on that. Okay? All right, everybody, there's a survey link in the chat. We appreciate you filling that out. It's been an interesting week, hasn't it? Hopefully next week is less interesting. I don't know. But hope you all have a good weekend. Thanks, Cam, for helping me on the chat. Fill out that survey, and everybody have a wonderful weekend ahead. Bye-bye, everybody.